Spencer and I come from the institutional world, but I started my career as an entrepreneur. When my son was 5, he had a little class party, and all the kids had to draw pictures of their mom. And all these boys stood up, and girls, and said, "My mom is pretty, my mom is a good cook, my mom, et cetera, dresses nice, my mom is sweet to my dad, I got my mom is responsible." So, I guess that is my identity. I'm responsible, and I love taking care of investors and working in the real estate industry, which is such a unique industry. My first job, this is Las Vegas, this is me. My father built Caesar's Palace and Circus and started taking me to work when I was 3. This is a 3-year-old, look at the strip, there's nothing there. So I say that I come from a great dad and growing towns, and this is in the 1960s. So I was born in 1965, this was 1968. And what I'm going to be talking to you today about is long-term cycles, but how it affected me emotionally and how it affected me in my decision-making as I was going through my career. And I think Spencer was talking a little bit about the past, but a lot about the future. And we need to think about things in perspective. If you woke up this morning and got on the news, it was pretty scary, right? The world's coming to an end. If the world comes to an end, everybody, none of this matters. So it's going to be guns and water. So that's not going to happen. This is my career. So I've started 5 companies. And I'm going to go through a little bit the lessons learned in each one of those. But first, I'm going to talk about cycles. I don't even want you to read this. I just want you to see the volume. This is from Wikipedia. This is all the US recessions from the Depression through COVID. And you could actually go back to the 1700s in Wikipedia. It's quite fascinating to look at because it puts what we're going through now in perspective, both the good and the bad, and how long these lasts. I am a massive fan of Ray Dalio. Who knows who that is? I know Ben does, and I know Scott does, because we talked about it quite a bit. And Ray Dalio is the biggest hedge fund manager and the most successful hedge fund manager on the planet. And he writes lots of books, and one's called Principles, which is very difficult to get through, but there's a lot of good stuff in there. He wrote a book called The Changing World Order, and his company is all about data collection. That's what he does because he needs to make decisions on a daily basis. And if you look at what a typical big cycle behind empires, he's talking 500-year cycles. Why do empires rise and fall? This is where it starts. A country comes in and they set the stage for being that reserve currency or that world power, peace and prosperity. There's some sort of debt bubble. There's a big wealth gap. Sound familiar? Then there's a debt bust. We've had those in our histories, in our lifetimes. And printing money and credit, that happens. We have seen that. Revolutions and wars. Hopefully we can get it together politically and understand that we're all Americans. I might run for office someday, so it's, we really have to come together. And then there's an unwinding and another world order, the rise of some other world power. This is a little bit difficult to see, but on the top, you'll see the reserve currencies over time. This is from 600, the year 600 to 2020. So you can see that these cycles are long. These are not 2 or 3 year cycles. These are long cycles where the rise of these reserve currency have taken a long time to go up and quite a long time to go down. And on this chart, you can see where the US is. We are definitely not down at the bottom, and where China is, which is the red line, which is rising. But in the beginning of this chart, they were the prominent world power. We talk about rates. This is the historic 30-year mortgage rate from 1975 through today. Look at rates in the 70s, 18.63%. When my dad was a developer, when I was in high school, he was borrowing money at 18%. Can you imagine how you make a deal work at 18% when rents were dramatically lower than they are now? So, of course, construction costs were lower, but 18%, what does that do to someone's psyche when they're in that business? We talk about rising interest rates, but put it in perspective, they're still quite low. What are the current 30-year mortgage rates today? Everybody wakes up, reads the news. Don't believe the media. They're there to scare you, right? Rates, oh my gosh, they're going higher. It's a difficult situation. What's going to happen? Look, put it in perspective. We're about where we were in 2020, and we're not going to get a whole lot higher, I don't believe. Why? Because we have massive debt that we can't pay. So we'd be in a lot more trouble if we raised rates. And then juxtaposed against the rates is the median and average price of new homes sold in the US from around my time of birth till now. Look at these numbers. Home prices have gone up dramatically. They came down a little bit in the global financial crisis, which you can see here, but they've still gone up, and real estate over time goes up. It just does. Take a look at any chart. It's just like the stock market. Did anybody think the stock market was going to get past 30,000? Raise your hand if you thought the stock market was going to get past 30,000 10 years ago. There was books, stock market 30,000. It was very difficult to believe that, but there it is. So this is my career. I kind of thought it would be fun if I mapped my own career against cyclical GDP. I think everybody in this room should actually do that, because what's fun about it is you can see how little experience you really have, regardless of the fact if you're 50 or 60 or 20. You really don't have a whole lot of experience over massive cycles. So I've been through a cycle where there were 18% interest rates. In the 70s, there was a big oil crisis. There was lines around gas stations. You couldn't get gas. There was a huge S&L crisis that lasted quite a long time, where all these big private equity firms in the real estate industry, like the Starwoods of the world and the Blackstones of the world, that's where they started, because they were able to buy real estate at dramatically below replacement cost. And that's where I started my real estate investment career. I guess most of you must remember the dot-com bubble, right? How many of you guys are in technology or were in technology, and women here? So there's a fair amount of people in the back that were in technology, so you remember the dot-com bubble. And then we had the global financial crisis. Oh my God, the world's coming to an end. And now we had COVID, which we're hopefully coming out of. And these are where I was at these points of time. So what is the emotion of a market cycle? Everything's cool, everything's the land of milk and honey, right? Spencer talked about the land of milk and honey. We're excited to be here. What's the opportunity? Things look great. Gosh, we made money over the past 5 or 6 years. And it's euphoric. And then we start to see little cracks in the system and we get anxious. Oh, and then no, it's not happening. It's not gonna happen to me. I'm okay. And then we start to get fearful, and that happens en masse. And there could be some desperation in there and panic. And then we don't know what we're gonna do. But remember, these cycles are long, and they come, every time they've happened, the economy has bounced back. And I'm happy to be talking to you today with everything that's going on in the world. I think this is a really opportune time to give this message to you. And then we start to get depressed, and we see little green shoots, hope, relief, optimism, life's great. How many have you been through at least one cycle in this room? Raise your hand, at least one cycle. A lot of you, 2 cycles, 3. Okay, not many. I've been through 5. So what are the lessons you can personally learn, and what can I share with you of what I've learned through these different cycles? both from a personal standpoint, how I handled them, and from a standpoint of investing, how I looked at the real estate market and what I needed to do to protect myself and my investors. Now, my most recent history is that I started a real estate debt fund. We originated $3 billion of debt across the United States. The loans were sort of from 50 million to 400 million. I structured them and sold pieces off to banks, and we had a very, very high return. We just announced that we're selling the company to a mortgage REIT, so I had an exit. I've had a few exits, which is a lot of fun. But I also feel like the timing on that sale was very good. So in the 80s, I was born in 1965. So in the 80s, I was still in college. I was going to USC. I graduated high school in 1983. I was going to USC, where I think I wrote a letter and sent in a check and I got in, but now people are going to jail to go to USC. So not worth it, but great school. So there was an S&L crisis. Real estate prices were falling. There was no debt in the market. There was lax lending practices and lax regulation that came out of the savings and loan because they were trying to get money out. And there was a tax advantage to taking losses that got cut off in 1986. So all of these things happened together, and a massive amount of property came onto the market. The government formed an agency called the RTC, and the RTC sold properties en masse to buyers very cheap. Again, that's where a lot of these big private equity firms got started. And what I learned through that, and I started working in 1988, I worked as a broker for 6 years, and then I got headhunted to work at a private equity real estate firm. And the way I got the job was there was a bunch of guys and me that applied for this job, and they gave us a problem, like go underwrite this office building. And so everybody came in with their beautiful spreadsheets, but I went to the market to find out through my contacts what was happening with the tenant. And the tenant was Times Mirror Corporation. And I knew the vice chairman at the time of the Times Mirror Corporation, and he said, we're moving out of the building. And the company that was gonna hire me didn't know that. So I walked into the meeting and I said, I can give you all the fancy spreadsheets you want, but the tenant's moving. They gave me the job because I was the one on the ground that got the market information before anybody else, and I approached it differently. So it's important to understand what's going on. Find mentors and gain perspective. There are a ton of mentors in this room. This is an incredible conference. It's really, really fun to talk to a lot of you, and it's a new experience for me. But you're all budding entrepreneurs or you're managing capital. Make the most of a crisis. What opportunities can you find? Spencer talked about retail. That is making the most of a crisis. Understand deal structure and capital stacks. Don't just think someone sounds good, they're a nice person, my friend invested with them, I'm going to write them a check. Figure out what does their debt look like? How much are they paying for it? What are their prepayment penalties? How much time do they have? Etc. Understand, ask those questions. And cycles are scary at the time. My first company, I was 29 years old, and I founded a company called Store America. The storage business is about half the size that it is now. And through the company I was working at, I saw an opportunity to build a storage facility on a piece of excess land. My boss told me to go do the research. I came back with a big package, and he said, oh, little girl, sell it. We don't do development. He didn't really say little girl, but. So through a friend, I met with an ultra high net worth family office, and they backed me. So the reason I got the backing is because I did my market research before I walked into that room. And it was one of the scariest things I ever did. I was 29 years old. There was a billionaire, his general counsel, his chief operating officer, and his estate lawyer. And they said to me, you have 5 minutes, go. It was like Shark Tank. And 45 minutes later, They were absolutely excited about the opportunity, and they called me back 2 weeks later and they said, we see over 1,000 business plans a year and we're gonna back you. And over 3 years, I built the company into, we had about 20,000 units, and we ended up selling it to I ended up selling the company, so that was my first exit. And build a great team and treat them right. We talked about the labor shortage up here, and we absolutely have to build great teams. And I've met a lot of the sponsors in this room who have amazing teams. Spartan, how many Spartans are there in this room? Raise your hand. Okay, there's a ton of these people in this room and at this conference, and I see the energy they have between them. Sol Urban's another one that I've seen a great energy between the team. And so that's really important. If you're gonna make an investment, meet the team. The next company I started was a company called AVP Advisors. .com bubble. AVP Advisors was an idea that I had because I walked in to the head of CalPERS. Does anybody know what CalPERS is? CalPERS. CalPERS is one of the biggest pension funds in the world. And he had a stack up to the ceiling of PPMs. And I said, Mike, what are you gonna do with those? I can't look at those. I have 4 people that work here, and I just invest with these 5 advisors. Let me do it for you. We'll do a fund-to-fund for, quote, emerging managers. We're gonna find people like you in the room, get them some CalPERS money, I'll manage it, and eventually they'll be able to go to you directly. So, farm team approach. Due diligence in that business was critical. We had to understand the transparency and what the operators were thinking, how they actually executed their business plan, and we needed to meet those partners and their teams in their office, look them in the eye to understand the dynamics. And if you don't like something that's going on, be a squeaky wheel. Ask questions, demand answers. It's your money. We ended up there, the global financial crisis hit. We were pretty much fully invested, and I founded another company called Oro Capital Advisors, which was a distressed investor. All we tried to do was find anything we could possibly buy, from banks, from liquidating trusts, anywhere. And it was a very windy road because the business plan really couldn't be that solid. We just had to find opportunity. And so there's a twisted road sometimes when you're not sure what's going on or what's next, but you gotta stay in the game and leverage off of others, use and exchange information with your relationships, and stay interested and curious. You don't know everything despite what you've already been through. And always, always, always continue learning. There's still a lot you don't know. Intuition. I can't say enough about that feeling you get when you feel like something's wrong or something's right. It's real. And so when we founded Mosaic Real Estate Credit, which was our debt company, we went the opposite way because we knew, not only intuitively, but through the data, that was the right thing to do. What did we do? We provided construction loans when banks weren't doing that business. So we went the opposite way. We were able to get some of the biggest private equity firms in the world to borrow money from us at 10% plus. We fostered new relationships because now I'm in the debt space, right? I had never been in the debt space before, but now I'm a lender, and it's a different business. And reputation that I built and that my partner had, who was the founder of the CMBS market, brings tons of opportunities. So build your reputation. It will bring you opportunities. And staying power in real estate. What do I mean by staying power? Staying power means that regardless of what happens, you're not gonna lose your property. You know your documents. You know your investors. You communicate. You don't over leverage. You have excess cash in the bank in case something happens. If you have staying power, you will not lose money. Generally. I'm sure there's exceptions to that. That's why REITs don't leverage past 40 or 50%. So, what have I learned over my career. And I'm going to talk about real estate lessons I've learned. And then I'm going to talk about personal lessons. So one, again, we've been talking about this this morning quite a bit. Cycles will happen. Have a research-driven strategy. Sign up for the CBRE reports, the Marcus and Millichap reports. Understand what's going on in the market, even if it's not the market you're focused on, but understand what's happening in the market in general, and get the real data. Do your due diligence. Don't just invest in somebody because it sounds good or your friend did it. Do your due diligence. Understand where your money is going, and that's for sponsors as well. Understand what you're investing in. There's a firm in the country. They're pretty big. They're a pretty big residential multifamily company, and they've been so successful that they've just been buying deals on the internet, not even going out and looking at them, because they're raising so much money. I won't say who it is. It's nobody in this room. Don't do that. Understand what you're buying. You have to see the property, and you have to understand the capital structure. Staying power is key. If your company or groups you're investing with don't talk about downside protection, that's not where you should be. I really, really, really believe this. You want to see a base case, and you want to see what is the downside of what we're doing. What happens if X, Y, and Z happens? I can't renew my debt. One of the biggest companies in the country, called General Growth, in the global financial crisis, it was a REIT. They had all their debt expiring at exactly the same time. They couldn't refinance anything. They went into bankruptcy. Bill Ackman, the hedge fund manager, bought a lot of stock. Brookfield bought a lot of stock. They restructured the company. And that was an opportunity for them because they didn't do the simplest thing. They didn't protect their downside. And this was a sophisticated, large retail REIT. Understand your leverage, meaning your loans. The devil is in the details. I'm a lender. I know what those documents say. Understand what the documents say. Sometimes you have personal guarantees. What does that mean? How long does it take? Different states have different foreclosure laws. Understand what those laws are in those different states. States like New York and Florida have judicial foreclosure. It could take 3 to 4 years for a lender to get your property back. So you need to understand what it says. And then know your counterparty. Understand the team. Understand the team dynamics, how they interact with each other. Do they get along? Would they allow you to sit in on a meeting of theirs? What's their reputation? Make some calls. What's their style? How do they operate? Are they transparent? Are they telling you what's going on? And are they delivering both good news and bad news? Nobody's perfect. And then really my 5 big personal lessons throughout my career are these. Show up. Be present at critical times. What does that mean? You have a vacation planned. There's a deal closing. There's a problem. You don't go. There'll be plenty of time. Be the person that shows up at critical times. I've had to do this so many times in my career, and I've had plenty of time to do other things for fun. Be the person who gets, can I cuss in this room? Be the person who gets shit done. So I was at a conference, and somebody was asking, a speaker was asking, hey, I need X, Y, and Z for stage. And somebody in the back pointed to a guy walking across in the back of the room. Go ask him. Who is that? That's the person who gets shit done. So if you can be that person, that reliable person, and leverage other people when you can, but be the person, be known as the person that gets things done. What is your unique strength? I've met so many different people at this conference. Every single person in this room has a unique strength. Did you have a tough upbringing? Did you have a great upbringing? Are you a great athlete? Whatever it is, that is what you can project. Don't try to be like everybody else. Be unique and leverage that. Allow that to be the thing that people remember you for. Be resilient, get up again and again and again after falling, and you will fall. But we only have one life to live, and we're here for a short period of time, so be resilient, and then be yourself and do the right thing. Meaning if everybody else in the room is doing something you don't agree with, we talk a lot in this conference about values, and I'm gonna end with this. Have your own values and stick to them, even if you're the only person that's standing up for those values. And with that, I really, really appreciate the opportunity to speak with you, and I'm looking forward to meeting more of you. Thank you so much.